Your application is being already judged. Before a loan officer reads your business plan. Before anyone looks at your revenue. Before you even get a single phone call. There is an underwriting checklist. Most banks and lenders has one. And before your business loan application ever reaches a human being, an automated system runs your business through that checklist. Most applicants have no idea this process even exists. Fail even one of the major items on that checklist, and your application may get rejected automatically before reaching a loan officer. Today I am going to show you the 6 biggest checks on the checklist most lenders use. Every item. In the exact order banks check them. I will show you exactly what you should fix before you apply, so that the next time you walk into a bank, or submit an online application, you already know you pass before you apply. Meet Jennifer. Her story is based on situations lenders and business advisors see every day. She owned a hair salon in suburban Ohio. 12 employees. Consistent revenue for 4 years. She applied for a business loan twice. Rejected both times. No explanation given either time. Just a letter saying her application was unsuccessful. She could not understand it. Her revenue was strong. Her customers were loyal. She had been in business for years. By every measure she understood, she should have qualified. But she kept failing something she could not see. Then someone showed her exactly what banks check before approving a business loan. She found 3 specific items she was failing, without even knowing it. She fixed all 3 in 60 days. Applied again. Approved for $40,000. Same salon. Same revenue. Same owner. 3 invisible fixes, and everything changed. Here is what she found. The bank checklist has 6 specific items. Jennifer was failing 3 of them. I am going to walk you through all 6 right now, and I want you to honestly check yourself against each one. Because I guarantee at least one of these is going to surprise you. Item number 1, your business legal structure. Banks want to see a properly registered business entity. An LLC or corporation. Not a sole proprietorship. Not just a name you do business under. A legally registered entity with its own EIN and its own bank account. If you are still operating as a sole proprietor, most bank loan systems flag your application automatically at this first checkpoint. Not because your business is bad. Simply because you have not taken the step that signals you are serious about your business as a separate legal entity. This was Jennifer's first miss. For years in business, still operating as a sole proprietor. She formed her LLC within a week. Jennifer thought she'd solved the problem. She hadn't. Item number 2, time in business. Most banks want to see a minimum of 2 years of operating history for traditional business loans. Online lenders often accept 6 months to 1 year. This is not negotiable, it is a hard filter in most automated systems. If your business is under 2 years old, the answer is not to wait. The answer is to find lenders specifically designed for newer businesses, like Fundbox and Credibly that we covered in earlier videos. Going to a traditional bank before 2 years is not brave. It is just the wrong door. Item number 3, annual revenue. Banks want to see annual revenue sufficient to service the debt you are applying for. A common rule of thumb, your annual revenue should be at least 1.5 times the loan amount you are requesting. Applying for $50,000? Banks want to see at least $75,000 in annual revenue. This is where many applicants make a critical mistake. They apply for more than their revenue supports. And the automated system rejects them before anyone even reads the application. Match your request to your revenue, and your approval odds improve dramatically. Item number 4, your personal credit score. Even for a business loan, most banks check your personal score as a secondary verification. Traditional banks typically want 650 or above. Online lenders accept as low as 600 in some cases. Below 600, traditional bank lending is effectively closed to you until you address it. Jennifer's personal credit score was 608. Just barely below most traditional bank thresholds. She spent 60 days paying down personal credit card balances, bringing her utilization below 30%. Her score jumped to 662. At this point Jennifer believed she was finally ready for approval. She wasn't. Item number 5, your business credit score. Specifically your Paydex score from Dun & Bradstreet. Banks increasingly check this alongside your personal score. A Paydex of 70 or above signals a responsible business borrower. Below 70, many lenders see elevated risk regardless of your personal score. Jennifer discovered this problem she didn't even know existed. She had no Paydex score at all. Her business had been running for 4 years, but had never built a single piece of business credit. No vendor accounts. No business credit cards. Nothing for Dun & Bradstreet to report. She was invisible in the business credit system entirely. She opened 3 net 30 vendor accounts. Uline, Quill, and Granger. Paid every invoice early. 60 days later, paydex score of 72. Problem 3 solved. And the one that changed everything most. Item number 6, and this is the one most people have never heard of, the debt service coverage ratio, or DSCR. This is probably the least understood check on the entire list. Ironically, it is also one of the biggest reasons otherwise healthy businesses get declined. Banks calculate this by dividing your net operating income by your total debt payments. They want to see a ratio of at least 1.25. Meaning your business earns at least $1.25 for every dollar of debt it needs to repay. If your DSCR is below 1.25, most bank systems reject automatically. This is the silent killer of loan applications. Nobody talks about it. Nobody explains it when you get rejected. But it is quietly eliminating applications every single day. Here is how to calculate yours right now. Take your annual net operating income, your revenue minus your operating expenses but before debt payments. Divide it by your total annual debt payments, including any existing loans, leases and the new loan you are applying for. If that number is above 1.25, you are in good shape. Below it, consider applying for a smaller amount or paying down existing debt first. Now, before you think passing all 6 items guarantees approval, there is one more thing I need to tell you. These 6 items get you past the automated system. But then a human loan officer reviews your file. And they look for 3 additional things. This is where applications that pass the system still sometimes fail. 3 things human loan officers specifically look for beyond the automated checklist. First, clean business bank statements. Loan officers specifically look for NSF fees, non-sufficient funds charges, overdrafts and irregular deposit patterns. Even 1 or 2 NSF fees in your statement signals cash flow problems and raises serious red flags. Second, consistency of revenue matters more than peak revenue. A business that made $100,000 in one month and $10,000 the next looks far riskier than a business making $40,000 consistently every month. Banks want predictability, not spikes. Third, loan purpose. Loan officers want to know exactly what the money will be used for. Vague answers like working capital or business expenses raise suspicion. Specific answers like purchasing 2 additional pieces of equipment to fulfill 3 confirmed contracts build confidence and approval odds. Here is what I want you to understand right now. Remember Jennifer. For years in business. Rejected twice without explanation. Jennifer was not rejected because her business was bad. She was rejected because she did not know what the bank was looking for. Nobody ever explained to her. She found 3 items she was failing on that invisible checklist. Fixed all 3 in 60 days. Applied a 3rd time. Approved for $40,000. Same salon. Same revenue. 3 invisible fixes. Now you know every single item on the checklist and every single thing the loan officer looks for after that. You walk into your next application knowing exactly what they are going to check, before they check it. That is an unfair advantage. Most applicants walk in hoping for the best. You walk in knowing exactly where you stand, and exactly what to fix if you do not. This week, run your own business through all 6 checklist items. LLC registered. Time in business. Revenue ratio. Personal credit score. Paydex score, DSCR calculation. Find the weak link before the bank finds it for you, know exactly where you stand before you apply anywhere. In the next video I am going to cover SBA loans, what they actually are, who genuinely qualifies in 2026 and the specific mistakes that get SBA applications rejected even when everything else looks right. Before you apply for funding, watch the next video, you know where the subscribe button is. And comment inside or below if you had no idea this checklist existed, or comment ready if you already pass all 6 items. Let us see where everyone stands before their next application.